Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we've got another investment video for you, and I'm going to be talking about the recession. Look, I follow a lot of investment channels, as you guys can probably expect, doing what I do for this channel. And it seems like every third Tuesday, every second Wednesday, and every Friday when it rains, there's a video on the recession. The recessions just seem to be coming in thick and fast in terms of videos. And I don't really want this channel to be focusing on the recession solely like that. I want this channel to be about investing as a whole. There is a whole world to the stock market, whether it's commodities, whether it's forex, whether it's tech stocks, whether it's stock reviews, whether it's IPOs, whether it's portfolio information, whether it's REITs and ETFs, whether it's fundamental data. The whole world of investing is a very, very broad and diverse place. So I'm not really a doom and gloom reporter that's going to just do it for clicks. I want you guys to kind of get a good, strong flavor of the whole world of investing. However, when there are events as significant as the events of today, it will be prudent for me to report on it just so you guys are aware. Not only that you are aware and you know how it will affect you, but also you can kind of potentially turn this negative situation into an opportunity. So that is going to be the vision for this video today. I want to talk about the recession, but I also want to kind of help you guys understand how this could potentially be an opportunity. So if you want to know more information about that, please like, please comment, please subscribe. I'm on a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get into this market slide as Germany faces recession and US and UK yield curves invert. Now, in my previous video on the recession, which as you can see was 3 months ago. So if you go to my uploads and you scroll down to all of these lovely videos, you'll find that there's a video 3 months ago with Elon Musk smoking a blunt. He's getting high and it's signifying that a recession is on the way soon. Is a recession coming? What should you do? I explain in detail in this video. It's not that long, just 15 minutes, what a yield curve is, what that means, and how obviously it can predict when a recession is on its way. But for those of you that have no interest in going back and checking this video, I'm going to give you the most quickest description of what a yield curve is. If it's not a long enough description, then go and check this video out, because obviously it is there and it has explained it in a lot more clearer than I'm going to do at this current juncture. But basically a yield curve is this. In the bond market, and a bond, as we know, is when we invest in companies, we lend to companies, which is a corporate bond, or we lend to the government, which is a government bond. In the bond market, here we're specifically focusing on government bonds. There are different terms for bonds, and this could be 3 months, 6 months, 12 months, 2 year, 3 year, 10 year, 12 year, 20 years, 30 years, etc. And the idea is this: the longer you tie your money up for, the more yield you should get in return. Pretty simple, right? If you tie your money up for longer, you're taking on more risk because you don't know what the horizon is going to happen, what the economy is going to be like in 10, 20 years. So you should expect a higher yield in return. What a yield curve effectively is that the shorter terms, so the 3 months, the 6 months, etc., are actually providing a higher yield than the longer terms. And what that basically signifies is that investors are dubious of what's going to be happening in the short term, so they only want to invest in the short term so they can get their money back, because they're worried that if they tie their money up for too long, then the market is going to be going in the wrong direction. And so what a yield curve is when the short-term bonds, depending on whatever term that they want to look at, so it could be 3 months, it could be 6 months, it's when the short-term bonds is now paying a higher yield than the long-term bonds. That in effect is a yield curve. And when this indication happens, there has been some analysis to suggest that any time from a few months to about a year and a half, a recession follows, and that's occurred, I think, the last 10 times there's been a recession. So that is why this is such a strong indicator, a strong metric, that the yield curve inverting is a sign of a recession occurring in whatever economy that the yield curve inverts. So it's obviously relative to the economy. If it's relative to the government bonds in the US, then that means a US recession might happen. It's relative to the government bonds in Germany, that means a German recession might happen, the UK, etc., etc. So the time I reported it previously was the UK had 2 instances of the yield curve inverting this year. And today has now been the 3rd instance. But not only that, the instance has also happened in the US, which is obviously a very, very strong sign. It's obviously the world's largest economy. And then I'm going to give you some information on what's going on in Germany. So let's get straight into this. Dow Jones. Wall Street tumbles after yield curve inverts. Stocks are sliding at the start of trading in New York as investors fear that an American recession could be looming. In early trading, Dow Jones Industrial Average down 425 points or 1.6%, S&P 500 down 44 points or 1.5%, Nasdaq down 138 points or 1.7%. Technology stocks and banks are among the fallers as traders shun risky assets. Bank of America shed almost 3%, while Apple has lost 2.3%. The inversion of America's government bond yield curve today has clearly worried Wall Street, given its track record of predicting recessions, which is obviously the information that I just mentioned to you a minute ago. And as you can see here, all of these stocks are down. So if you guys hold any of these stocks, it's not a microeconomic issue. It's not an issue with Facebook specifically. I hold Facebook. Zuckerberg hasn't done anything this time. They haven't gone and, spied on, someone in Kazakhstan or whatever. There is nothing that Facebook has specifically done. This is something on a macroeconomic level that's going to be affecting a lot of technology stocks, a lot of banks, and obviously other stocks as well. But these are the 2 sectors that this specific article has obviously been focused on. So I'm not going to go into why the yield curve predicts recessions because I have got a video on that. So if you want to know that, go and check out this video. And honestly, it's 15 minutes long, but it will explain it in a lot more detail and it will make it very, very clear for you. But let's carry on today. So if we scroll down over to 4 hours ago, it says the UK stock market hits 2 months low. Britain's FTSE 100 index of top blue chip companies has hit its lowest level since early June. The FTSE has shed 102 points to 7,148, the lowest level since 4th of June. And in fact, I think 24 minutes ago there's been an update. So Britain's FTSE 100 stock index has just closed down 103 points at 7,147. That's its lowest closing level since March this year, and means the index has lost over 400 points since the start of August. And there's probably some more information there about that. Let's go back to the future or forward to the past, whichever way you want to look at it. Recession fears surge as US yield curve inverts. The US yield curve has inverted, intensifying fears that America's economy could be falling into a recession. For non-bond experts, that means the interest rate on the 10-year American government debt has now fallen below the rate on the 2-year equivalent. So that's the terms that they're looking at. So in the previous video, I talk about the 3-month and the 10-year, but there can be different terms that they want to look. Effectively, it's when the shorter one is now paying a higher yield than the longer one. And it's usually anchored at the 10-year, but the shorter term can obviously vary. Now, falling below the 2-year equivalent. Right now, 2-year treasuries are trading at a yield of 1.634%, while 10-year bills only offer 1.628%. In normal times, longer dated government debt should offer a better rate of return, as there's simply more time for something to go wrong before the money is due to be repaid. So an inverted yield curve is a worrying sign. It implies that investors are more pessimistic about future growth prospects. In the past, an inverted US yield curve has been followed by a recession. Now, I'm going to just scoot over to this link, which I will put in the description. I go into this in a lot more detail in the previous video as well. But when that comment just came out that inverted yield curve has been a predictor to the recession, this graph explains it so beautifully. It's from JP Morgan. And what you can basically see here is that these dark grey areas is when a recession has occurred and how long the recession was basically for. And this green dot here is when the inverted yield curve has occurred. And so what it basically correlates is that apart from 2 instances, all other instances when there's been an inverted yield curve, a recession has happened at a certain time afterwards, and the average time frame was 14 months. So when I produced that video 3 months ago, I mentioned that I predict a recession will occur within 6 to 14 months, and that was based off the fact that obviously a recession is characterized as a quarter of negative growth, and so obviously 2 more quarters of that would be the 6 months period, and then obviously anything up until 14 months, which is based off the yield curve. So that's where my prediction came from. So We've already had the first quarter in the UK, as you guys know. If we have another quarter, that means it would be 6 months from the time that I produced that video, and that means we technically will be in a recession. So that is where my prediction in that video comes from. If anyone is wondering why I predicted a recession will happen in the next 6 to 14 months as well. Now, one thing to really note, which I want to get into, is the Germany situation. Now, as you can see here, Germany's economy shrinks. Good morning and welcome to our rolling coverage of the world economy, the financial markets, the Eurozone and business. Good morning. Now, Germany's economy has shrunk, fueling worries that the Eurozone could be teetering close to a recession. Europe's largest economy shrank by 0.1% in the second quarter of 2019. New data shows following 0.4% growth in the first 3 months of the year. So, just to make that clear, in the first 3 months they did fine. Now in the next second 3 months they shrank by 0.1%, and Germany is Europe's largest economy. It's not the UK, for those of you guys thinking it was the UK. It's actually Germany. And this graph here, I'm going to show you, just it gives you an idea of the strength of different economies. This orange line here is the United States. So obviously the United States is the world's largest economy. Germany is this blue line, as you can see here. So I think their economy is now worth 3.67 trillion. Although the date is 2017. I think I can scroll across. No, I can't. Anyway, the date is 2017. I will try and find out why. But UK is here at 2.62 trillion. So Germany is Europe's largest economy and has been Europe's largest economy since 1970s, it seems here, but probably for a longer time than that. And so when the German economy is shrinking, that is not going to bode well for the whole of mainland Europe in general, but also UK is obviously still part of Europe, and so that doesn't really bode well for the UK as well. So again, a lot of the time with UK stocks or with stocks in general, a lot of these companies have, trade agreements with a lot of different companies around the world. Sorry, a lot of different companies, people, investors, individuals around the world. And so when economies are shrinking in other places, it can have a negative effect where you are geographically, even though it's not a direct effect. It's just because of the way that money is flowing between these different economies. So if I go back to the article, Europe's largest economy shrank by 0.1% in the second quarter of 2019, new data shows, following 0.4% growth in the first 3 months of the year. The Federal Statistical Office reports that Germany experienced a slight decline in economic performance in the last quarter as it was dragged down by a fall in import-export, as I just mentioned. The Status also reports that Germany's economy only grew by 0.4% over the last 12 months, which looks to be the weakest performance in several years. This data confirms that Germany has suffered a blow from the slowdown in the global economy and the US-China trade war, which hurt demand for German-made goods. Now, this is just a very, very... I really like this. Well, I don't like this, but I like the way that this is laid out here, just because it just shows you in a number of paragraphs that everything has an impact on everything else. It's like a domino effect. If, Trump does something with China, that can have an impact on Germany. Germany being Europe can have an impact on the UK. Everything can have an impact on everything else. The way the economy is structured and set up, there is an absolute interdependency on countries to coalesce and get along with each other, from an economic standpoint, that is. And so this is just a great way to kind of convey that, I think. And so just the takeaway I want you guys to think about is that just because something is happening offshore, just because something is happening in a country that might be 3,000 miles away, it doesn't mean that from a financial and economic standpoint, it's not going to impact you as an investor. The chances are, in some way, shape or form, especially if you have a diversified portfolio, it will impact you in some way specifically. 7 hours ago, there was this. So UK and Germany lagged behind the rest of Europe. The UK and Germany, Europe's largest economies, were also its worst performing members in the second quarter of this year. They, along with Sweden, were the only countries to suffer a contraction in April to June. Italy performed poorly too, with no growth, while France and Belgium managed a lackluster growth of 0.2%. Here are some highlights from today's growth report from Eurostat, which includes today's German GDP data and last week's UK GDP data. And I mentioned in my most recent recent portfolio update that obviously there was negative GDP data, and that is obviously an indication for a recession. So guys, just so you know, a recession, if I haven't explained it earlier on in this video, is 2 consecutive quarters of negative GDP growth. So if there is a contraction by 0.1% or more, or it could be 0.01%, as long as there's a contraction for 2 quarters consecutively, technically that's a recession. And now a recession might only last for, you know, a few more quarters after that. However, just because things are so interlinked, it generally can be longer. But it doesn't mean it's going to be as dire and catastrophic as the 2008 recession, the global crisis that we all saw or know about. But it does mean that there can be a significant recession and a significant impact to your stocks as well. So these are the events that have basically occurred today, which is pretty significant. You've got Germany declining, the UK declined last week in terms of GDP growth. You've got a UK yield curve that's inverted again. You've got a US yield curve that's inverting, which obviously sees a lot of American stocks that's declining. And so potentially, if there is another quarter of negative GDP growth, we could be in a recession as soon as 3 months' time, effectively. And so, what I want you guys to take away from this is, what can you effectively do in order to deal and counteract a recession and sort of manage it? Now, there's a lot of different strategies that's out there, and I'm actually going to make a part 2 of this video, go into it in a lot more detail, and I'll probably do that in the next couple of days. But just to give you some key takeaways, some investors do absolutely nothing. They do absolutely nothing. They invest irrespective of what's going on out there. If they're dollar cost averaging, for example, they continue to dollar cost average. It does mean that every time they're buying stocks, they're potentially each month buying at a lower and lower price. But what they're seeing it as is that they're going to effectively be buying more shares, getting more value, and effectively they continue buying. So in the future, when it does bounce back, they get a lot more, return for their money. Let's call that approach A, doing nothing and just carry on as normal. Approach B is what other investors who are a little bit more cautious might do. They start investing in commodities or things that hedge against the economy. So you might have investors that invest more into bonds rather than investing into stocks, or invest more into gold. So this is the reason why you see gold start to rise when economies and equities start to fall. And now more recently, cryptocurrency. Cryptocurrency is a way to hedge against a global fiat economy. And that's the reason why you're potentially going to see Bitcoin and some of the other coins as well start to rise considerably during this period, because faith and trust, etc., in standard economies controlled by central banking authorities is going to be down, as the people are going to go to this economy. So option B is that people start to hedge, which means they're going to invest in commodities, which could be gold, which could be bonds, which is obviously not a commodity, but they either invest in bonds, invest in gold, or invest in crypto, which is a form of a commodity as well. Option C, another approach that people might take is that they stop investing. They stop investing and they stockpile cash. And so what they're effectively doing is saying that, look, I would rather time this now. So I'm going to start saving my money in cash, because I don't know when I'm going to need that money, and I don't want every time that I invest, it loses value straight away. And when the recession feels like it's at its bottom or at its worst, I'm then going to put all of that cash back into the market. And then hopefully that I've timed it well enough that it will start to rise. Now, if you time it poorly, you could put all of that money back in and it could still drop another 20% or 30%, who knows? Or if you time it really, really well, then obviously when it does go back up, you can make a considerable amount of money. So option C is going to be those investors that are going to try and time, the recession in that specific way. So you got these 3 main options. Now, there is obviously other things you're going to do, but you've got people that are going to carry on doing nothing. They're going to not do anything different effectively. You're going to have the people that's going to hedge, and you're going to have the people that's going to effectively try and time it. You might have option D, which is people that try and change their portfolio up. So they still invest in equities, but they might invest in more what they call recession-proof stocks. And this could be, your things like McDonald's or your BPs of the world, or your established 200, 300, 400-year companies that have just been around forever and will continue to always be around, because they will continue to pay a dividend, and that might be another way. So in fact, let's say that there's 4 approaches. I'm going to go into these approaches more in the part 2 of this video. But those are some ways that you guys can start having to think about how you can potentially deal with a recession that is impending. Now, is there a silver bullet? Is there a right answer? Absolutely not. And I always say this: if there's any analyst or any individual that tells you this is the exact way to deal with the recession and this is the exact way that's going to work, they are lying to you, or if they're not lying, they're misinformed. There might have been strategies that have worked for them but have not worked for others, and there might have been other strategies that could have worked a lot better as well. So there is no one silver bullet. It's all about finding, your style, and I'm very, very specific about this. It's all about being tailored to you, your style, your current financial situation, and then working out the best scenario for you. But I will get into that in a lot more detail in part 2 of this video as well. So I want to kind of dedicate some time to really, really focusing on the opportunities that a recession could potentially present, because a recession obviously seems like, not obviously, but it does seem like it's on its way, not just in the UK, but across Europe and potentially in America as well. I hope you guys found this video useful. If you did, please like, please comment, please subscribe. Definitely check out part 2 when I launch it. I do anticipate launching it over the next couple of days, to give you guys a little bit more on the side of what you can do to kind of counteract it, and go into a bit more detail on the different strategies that people take. And there might be more strategies that I discover over the course of the next couple of days before I produce that video. So please be on the lookout for that. But yeah, that's effectively where the economy is happening today. So in terms of your specific portfolios, what you might be seeing is a lot of falls. It's not even the right term. You might see some fall, some drop in the value of a lot of your stocks. Again, it's nothing to do with your stock picking abilities. It's nothing to do with the fundamentals of your company. Well, it might be to do with the fundamentals of the company, but the chances are, if you're seeing it drop today, it's more a global economic issue, which is now affecting your individual economic stocks as well. And yeah, tomorrow I'm also going to tell you what I'm going to do. I think I've decided what I might do, and so I will give you some information in terms of how I'm going to deal with that as well. Or not tomorrow, when I produce the next video. Anyway, I hope you found this video useful. Please like, please comment, please subscribe, and I will catch you next time with part 2 on how to deal with a recession. Take care, guys.